Rees Group and Discover. And Discover Financial Partners property briefing for 2022. It's been a few months since we've had our last one, and we thought we'd get the team back together. I'm Justin Astoris, Managing Director of Rees Group. To my left, I think it's left on your screen, is Matt Gibson. I've noticed our names around the other way, Matt, on screen. We've got today Adam Murchie from Forza Capital and Daniel Gradwell from ANZ, who's now Associate Director in the Property Division of ANZ. It's been a very eventful 24 months in property, so we thought, as I said before, it was time to get together. We found the feedback from people in the last couple of years is this webinar is time effective for everybody, and also gives everyone a chance to Q&A and allows them to have the questions coming through and us panel those later on, which we'll do. Our format's going to change a little bit today, so Daniel's going to present some economic data, which we're really looking forward to hearing in relation to what's been happening, interest rates, and obviously some other property data as well. And then what we're going to do for Adam's section is we have a question session where Matt Gibson and myself will ask Adam some questions, and that will also open up the ability for you to ask questions both to Adam and to us as a panel, including Daniel. So there's a Q&A section in your Zoom there, so you can just basically click on the Q&A and enter a question. I can see those, so Matt and I'll moderate those questions as they come through. So I'd like to hand across to you, Daniel, for your presentation, and we'll keep moving from there.
Perfect. Thanks, Justin, for the intro. Let's just bear with me while I get my screen sharing. So can you just confirm that you can see that okay now?
We can.
Beautiful. All right. Thanks, everyone, for joining us. And I've been doing a lot of these virtual sessions, obviously, for the last 2 years. And I'll just echo Justin's comments there. Please get some questions in where you can, because the only downside of doing these online is that it's really hard to point at people and make them ask some questions afterwards if there's nothing. So I think the more interactive session we can have, the better it is for everyone, and we can really dig into what's interesting and helpful for yourselves. So I've got 5 slides to get through today, so hopefully that's not too painful for everyone, but I'm going to talk you through them really easily. We'll start off with a bit of chat around the broader economy, what looks good, where some of the risks are, and then we'll have a think about the housing market in particular, and then wrap up with what I think is some pretty cool data from ANZ that we can monitor from people's spending patterns, and we'll think about some of the implications of how people are spending their money these days and how that's changed over the last couple of years. So if we kick off, when I can change slides, beautiful. I think this is an interesting one. The chart's a bit of a mess, but the story behind it is pretty cool. So when we're thinking about the overall economy in Australia, you normally think of GDP as the main indicator. That came out a couple of weeks ago, and it showed a really nice rebound at the end of last year. But the problem is when it says December data, that's really talking about October, November, December. So it's incredibly out of date by the time it gets released in March. So I think actually a way better way of thinking about the economy is what's happening in the labour market. And you can do that a few different ways. You can look at things like job advertisements, job vacancies, or just straight up employment and unemployment. So what we're looking at here is the light blue line up the top, and that's your employment to population ratio. So you can see that that had sort of been climbing a bit before COVID up to 2020, fell off a cliff when COVID arrived, but since then it's rebounded really strongly. So before COVID, about 62% of the population had a job, and now it's up to 63%. So there's record numbers of people employed at the moment, and it's a record share of the population as well. So that's reflected in things like the unemployment rate down at 4%. It really is the strongest labour market we've had in years and years in Australia. And that's a really good starting point. But I guess where some of the risks and problems start to come in is, and this is the key part of the chart that I've circled here, there's a real gap opening up between the performance of the labour market, which looks good, and consumer confidence, which looks increasingly bad and negative and worsening. And that's the dark blue line. So obviously, when COVID arrived, consumer confidence fell off a cliff. It rebounded quite nicely. But for the last couple of months, confidence has really been falling back down again. And aside from when COVID first hit at the start of 2020, consumer confidence is now the lowest since the GFC back in 2008. So it shows you that consumers, even though a lot more people are working, we're seeing a bit of wages growth coming through now, people aren't particularly happy at the moment. And pretty easy to think of why, right? There's some pretty serious conflict occurring, of course, in Ukraine and Russia. People are seeing rising petrol prices. In general, the cost of living is escalating faster even than what wages are doing at the moment. And then, of course, there's concern about when higher interest rates are going to come through and what that's going to mean for people's mortgage repayments as well. So even though the labour market looks good, there's definitely some real challenges out there that are causing people a bit of concern. Now, the reason I sort of flagged that as one of the key risks is because if consumer confidence keeps falling and remains weak, then over time you start to see people saving their money instead of going out and spending it. The problem there is that household spending is by far the largest part of Australia's economy. It's about 50% of our GDP. So whenever people do sort of tighten their budget a little bit, stop spending, that has a really material impact on household consumption and the overall GDP or growth within Australia. So that's one of the key risks that we're looking at going forward. And obviously that sort of captures all these other bigger pictures, like I mentioned, around global conflict and interest rates and that sort of thing. So this is a picture that I think we should keep an eye on going forward, with a lens to the fact that falling consumer confidence, it's not just a little indicator that gets released every week. It can be a pretty good leading indicator as to where the health of the overall economy is going. So I think that's an important story. So we can say that things overall look pretty good at the moment, but households are a bit concerned, and probably rightly so. And it's almost a similar story when we start thinking about the housing market as well. Things have been pretty strong for the last couple of years, but you're definitely starting to see assessment of some of those risks coming through now. So what we're looking at on the chart here is just the way that housing prices have moved since COVID arrived, split across different types of property within Melbourne and regional Victoria. So there's a couple of themes here that sort of jump out at you. The first one, if you look at the gap that's opened up between house prices and unit prices, so the way that the orange line has grown at a faster rate than the blue line, which is units, shows that houses have outperformed. They initially fell a bit further, especially in Melbourne during lockdowns, but since then they've recovered quite nicely. And prices of houses are up sort of 10 or 12% around Melbourne. That's actually a fair bit lower than house and unit prices have performed across other parts of the country. Places like Sydney, Brisbane, Adelaide, Hobart, not so much Perth, but definitely the first ones I mentioned, have seen price growth more like 15 to 20%. So Melbourne has lagged a little bit, probably due to those recurring lockdowns. But within Victoria, it's been an even stronger story. And you look at the grey line up the top, the strength in house prices in regional Victoria has been absolutely incredible. Prices up about 30% just in the last 2 years. So that's incredible growth. And that's pretty consistent with the regional areas in all other states around the country as well. Now, if we're thinking about what sort of changes within that story are going to persist over the long term, I think a couple of them stand out. The first one is the regional piece. What's interesting there is that we probably all know that population growth in the regions has been strong since COVID arrived, with the advent of, or acceleration rather, of things like working from home, people able to earn the capital city money and live regionally. But what's really interesting is that that's not just driven by people from the capital cities moving to the regions. That's definitely occurring, but actually the larger change has been fewer people leaving the regions and coming into the capital cities. So people in the regions are more likely to stay put now, and that's having a really material impact on the population growth and therefore housing markets in the regions as well. So I think that's a really important thing to keep in mind, because if you're thinking about the long term, if that was only driven by people from capital cities moving to the regions, I think quite rightly you'd have some questions about, oh, but what if their life circumstances change and they have kids and the education or healthcare system isn't what they're accustomed to back in the capital city? You might see them moving back in a couple of years' time. But I think it's important that a lot of the change in the regions is people staying put instead. They're already accustomed to the way of life out there, and they're choosing to make that decision much more fully informed than people moving from the capital cities going out there are doing. So I do think that shift towards the regions is going to be something that sticks around for a pretty long time. The second piece is just the divergence between houses and units, and that's only one way of looking at it. I'm also sort of thinking there around things like the number of bedrooms, 4 bedrooms versus 3 bedrooms, for example. A house in the suburbs, previously for a lot of people, a 4th bedroom might have been a nice to have, but increasingly with working from home, even under a hybrid model where you might be working from home 2 or 3 days a week, all of a sudden that 4th bedroom or 4th bedroom / office actually becomes a necessity rather than just a nice to have. So I think that's going to drive a bit of a shift in all sorts of housing markets as well, where people do just need a bit more space than what they had previously. And unfortunately, where I mentioned units beforehand, we're not very good in Australia at building larger units or apartments that are a good quality stock for larger families, whether it is 3 or 4 bedrooms or second living areas and that sort of thing. We don't do that particularly well. We tend to build more high density studio 1 or 2 bedroom apartments. So that part of the market is a bit of a gap, I would suggest. And I think that partly explains some of this divergence between units and housing prices. And I think that theme will persist for a bit longer as well. What definitely won't continue, though, is the record low interest rates that we have at the moment. And clearly it's only a matter of time now until rates do start to rise on the back of that story that I mentioned before around wages are starting to increase, but certainly the cost of living and inflation in general are really accelerating now, and that's got a bit further to run. So one of the ways we can think about the implications of that for the housing market and for the economy more broadly is we can look at the way that people's household interest payments are going to change when interest rates start to rise. So the way to look at this chart, the dark blue line is the share of household income that's needed to pay the average interest bill. So for a number of years up until COVID, it was around 9% of income was needed to pay interest. Interest rates got absolutely cut down to near zero, and now it's only about 5.5% of your income needed to meet your interest bills. So what we do going forward is we forecast what happens to that percentage as interest rates rise. And if you just look at the light blue dotted line, that's the market pricing for the RBA cash rate over the next couple of years. So they've got some pretty aggressive rate hikes starting around the middle of this year and really continuing through at a fast pace the remainder of this year and all through 2023 as well. And what's interesting is that even under that aggressive rate hike campaign by the Reserve Bank, if it does eventuate, is it still only gets your average interest bill back to that 9% mark where we had been for a number of years anyway. So I think that's quite important to keep in mind. Clearly, there will be people that are more affected than others. If you've just bought your house more recently, you're going to have a higher debt level, of course. You're going to be more highly leveraged than people that have got 10, 15 years equity in their home. So there will be some real lifestyle adjustments for some people along the way. But I think the reassuring thing is when you look at this chart and you say, even with these rate hikes priced in, we're going to go back to the same sort of interest imposition that we had for a number of years before COVID anyway. It tells you that there's not really a screaming signal there that mortgage unaffordability is going to be a massive issue. It doesn't look like we're going to have people defaulting and running into issues in 12 months' time. So I think that's probably a good news story. However, acknowledging within that, there's definitely going to be pockets of people that do come under a bit more pressure. Now, it's hard to talk about all of this because there's so much in 15 minutes to get through, but that's kind of the framework that we're thinking about housing markets in general at the moment. Things look pretty good, but acknowledging that over time, interest rates have been the main driver of prices, both on the way up and on the way down, that inverse relationship between the two. And there's no reason to think that won't be the case this time around as well. Now, one of the bits that I just wanted to finish up on is some of this ANZ data that I mentioned earlier. So once again, we've got some pretty messy charts here, but I'm going to try and talk through them. So when we're thinking about spending at the moment, if your house is anything like mine, you're probably getting packages delivered pretty well every day at this point, which is cool in a number of ways. It feels like Christmas every time you get something dropped off. But definitely it has some real implications for commercial property markets. Now, why don't I talk about the last couple of years? If you look at the dark blue line for 2020, this is looking at the share of all retail spending that's conducted online. So in April, May 2020, there was that massive spike up to about 35% of all retail was spent online because of lockdowns. You had the same again, if you look at the orange line, 2021, you had the same again from July through to about October. Again, that large lockdown in Melbourne and Sydney driving a lot of that change. But what's interesting is if you look at, even though the economy is open now, we're still spending a lot more money online than what we were doing only a couple of years ago. And that's the part that I've tried to circle on the left-hand side. The red line in the middle there is what's happening in 2022 so far. And you can see it's pretty much in line with the orange line, which is last year's experience. So about 20% of our spending is now online. So no real change this year compared to last. But I think the key is going back only a couple of years, you can see the magnitude of that change. It's about 50% more than what we were doing online in dollar terms compared to pre-COVID. And it's roughly double what we were doing in 2018, so only 4 years ago. So a really material change, and that's coming across all segments of spending as well. I won't get into commercial property too much here because I know Adam's going to give us some great detail on that after this session, but obviously that makes intuitive sense when you're thinking about the way that the industrial property segment has been red hot for a couple of years now. The storage, warehousing and logistics sector accommodating all of this online spending is really important. And it does look like that is here to stay, even though the economy is opened up. I think if anything, the risks are that we continue to spend more online rather than retreat back to where we were a couple of years ago. So that's one part of the data I wanted to talk about. The other piece, and this is my last chart for the day, is instead of thinking about how people are spending their money, just wanted to demonstrate a bit around where they're spending it and the extent to which that is not in the CBD at the moment. So, I mean, this won't surprise anyone, right? We're still sort of slowly coming back out of lockdowns, and I'm sure everyone's experienced is that they've been in the CBD less than what they were doing 2 years ago. So it won't be a surprise, but we're just trying to quantify how some of these shifts have occurred. So this is looking at the volume of transactions at cafes in the CBD across Sydney and Melbourne. So after reaching that low last year of, we were down to about 10 or 15% of normal levels, it's been a nice wee recovery for both places that I've highlighted in the circle. And we're now at back to about 60% of pre-COVID levels being spent in the CBD. So it's a good recovery, but there's still a long way to go. And I think the thing there is that back in 21 in Sydney and Melbourne, we only really got back to that 60 or 80% of pre-COVID levels. So that means I think it's going to be a challenge to push past that 60 or 80% again this time. So this is one bit of data that I'll be looking at really closely going from here. We get this, I think, on a weekly or fortnightly basis, which is another example of the really timely data that can be quite powerful. But I guess the point is it's going to take a long time before we can truly determine the long-term levels of office CBD occupancy and what that's going to mean for the surrounding assets. So obviously thinking about the office segment in particular, but it also plays into the retail property story. And from a banking point of view, we've definitely seen things like CBD retail assets have been under a lot of pressure. But the flip side of that is retail spending is at all-time record levels. It's just not occurring in the CBD. So it's occurring online and it's occurring in the suburbs. So although I'm saying that CBD retail has been under pressure, we've seen the flip side of that for your neighbourhood shopping centres, and those types of assets generally have performed quite well through COVID. So again, that's another piece that we'll be keeping an eye on to determine where that sort of balance ends up over the longer term. Now that's probably enough for me. I'm not sure if that was about 15 minutes. I tried to get through it at a decent pace. So I'll hand you back over to Justin for the next session and look forward to taking a few of your questions afterwards. Thanks.
Thanks, Daniel. That was really informative. Some good data, especially around sort of this CBD spending that we'll talk about with Adam. We dropped off.
Guys, can you still hear us okay?
Yep.
Yeah, good. Let's jump into to having a chat with you, Adam. I think some of the points that you've touched on there at the end, Daniel, I think will be quite interesting to hear your follow-up observations, Adam. I know certainly late last year you completed quite a significant commercial office transaction in Melbourne CBD, and I think it might be quite interesting just to hear a bit about your view on Melbourne CBD and some of the reasons that you formed the view around the attractiveness of still investing in CBD property. But also I think it'd be good, Adam, just to hear a bit about just overall your observations around that reversion theme that Daniel has been talking about, and what your view is there about what's likely to stay and what might revert post-COVID as far as commercial property trends.
Yeah, it's three-dimensional, right? I mean, there's everyone has a view. It's actually quite hard to dig through all of the information out there to find the source of truth, if you like. So reading that data was interesting. I mean, it's what you'd expect given the situation, but the situation is somewhat an absolute, well, not somewhat, it is an anomaly in any event. So you sort of got to take cues from places afar that have been through not dissimilar sort of situations, being, particularly Pan-Asia with SARS. We sort of have been speaking to quite a few people that were party to those exposures during those events to understand what the sort of thinking and the behaviour is. And there's a strong correlation with what's played out on the ground here. But I mean, from a property perspective, a lot of stuff has changed in the last sort of 10 to 12 years. So if you went pre-GFC, the pecking order of property was probably retail, office, industrial. Post-GFC, it became office, retail, industrial, and now it's it's industrial, office and retail. So the whole market, in terms of the way it's viewed from capital markets, has inverted over the last 10 to 12 years, which is quite interesting. And certainly that's accelerated inside the last 2 or 3. I mean, industrials.
I think we've had a connection issue with Adam. I know we lost his video, so hopefully he can join back in. Dan, we might come back to you if you don't mind, just until Adam comes back on. So I apologise for the technical difficulties. It sounded like he had a connection issue there at one stage. Daniel, did you have any feel or data just around what we were talking about before about this reversion to offices and the spending we're talking about? And I know a lot of government departments are not back into the CBD yet up the eastern seaboard. Do you have any data around that?
Yeah, not so much in terms of direct occupancy rates. It's more the spending piece that we look at. And I mean, I showed you the CBD cafe stuff, and you can kind of do that for a bunch of other indicators around transaction volumes in the CBD as well. And they're all a pretty similar sort of story. Really hard to get a good handle on where you end up longer term, though. It feels like a lot of businesses at the moment are taking a slowly sort of approach, not necessarily mandating how quickly people need to come back, but I'm sure that's in the back of their minds. But I've got to say, what I find really interesting with the office piece is that a lot of asset owners will talk about the productivity enhancements from people being back in the office, but I think data on that are really, really hard to come by, and I definitely don't think it's a one size fits all approach. So I find it really hard to think that we'll go, eventually back to 5 days a week back in the office. I don't think many people want to do that, just as not many would work from home 5 days a week. Doing that during lockdown is really, really challenging. And that's where I think the hybrid model has a really significant role to play. And then you can kind of run some scenarios, just on the back of an envelope, and you think, well, if a lot of people are going to be doing 3 days a week in the office, maybe 2 at home across X amount of occupations, then you can kind of get back to a occupancy rate of maybe 80% or something of where we were before COVID. Maybe one other comment on the office space that we're seeing from a bank and finance point of view is that flight to quality has been really, really strong. And I'm not sure if that's something that Adam was going to touch on as well. But absolutely, it feels like businesses and asset owners are really thinking of, instead of just forcing people to come back into the office, let's make it attractive for them to do so and give them a real reason to come back in. So thinking there around things like end of trip facilities and your various amenities around the building as well. That's all really important stuff. And I guess to go back to the language that I used in my presentation as well, I think I said something around, it was around online retailing, the fact that that was already increasing in volume pre-COVID, as was a demand for end of trip facilities and different amenities. But COVID's really just been an accelerator that's kind of poured a bit of fuel on that fire. And now it's even more important than it was a couple of years ago. So I think there's still a way to go before we know where it ends up. But absolutely, I can't see a world where we go back to where we were 2 years ago.
Yeah, I think that hybrid model is interesting. We've been putting some information out through our blog just in relation to keeping the team engaged. And I know Matt will endorse what I was saying. We just had a birthday cake before for someone, but just having everyone in the office, not everyone's in today, but we've got probably about 80% of our joint team in, and there is an element of social interaction that you just can't deny. And I know Adam, who is meant to be joining us and coming back on, we're just waiting to see if he can. He had some technical issues at his end. You know, he's got some facts around the office not being dead. And then whilst the recovery, Daniel, might be a little longer than we like, especially in the CBD. I was in the CBD yesterday in Melbourne, and it was humming, but it wasn't buzzing. You know, it was busy enough. But you know, coming back to your 60% of spending in cafes, I think it's probably about that level.
So just going back, Daniel, to the slide around percentage of disposable income, I found that fascinating that in such a short space of time we saw such an easing of the burden of mortgage expenditure on a household budget, and then the snapback. Yeah, I haven't seen it displayed so as clearly as that, but I guess across that journey, we also have had differing bank serviceability constraints as well around servicing rates, and that's moved quite substantially and ebbed and flowed through that period as well. So if we combine those two things together and look at that from a future standpoint around capacity to borrow for residential borrowers, what does the bank have any sort of a read on that and what that might look like within a rising interest rate environment?
Yeah, absolutely. And that's a really good point that I didn't touch on. And obviously it goes back to your servicing calculations that are sort of mandated by APRA, and we saw that was relaxed by 50 basis points or so in the second half of last year. So that did increase the capacity a little bit. But then it's even your sort of soft and almost intangible factors as well. And I'm thinking there even back to the Banking Royal Commission back in 2019. And for anyone that's basically applied for a mortgage or a refinance with a different bank since then, I'm sure the process would have been a lot more difficult, plenty more hurdles and hoops and all that sort of carry on than what you would have had in the past. And I think by and large, that's been fantastic. And you can see that across the various banks' mortgage portfolios at the moment. Default rates are very low. Yes, a lot of that ties into the strength in the broader economy, but it does mean that the mortgage portfolio is in good shape overall. And if you look at things like APRA stats on high leverage, high debt to income sort of loans, they are sitting around low levels as well. They have picked up a little bit recently, but they're much lower than they were in years gone by. So I think there's a lot of stability out there inherently in the system now, which is great. And it should provide a bit of a buffer for when those higher interest rates do start to come through. And then maybe just one more point on that, actually. We're sort of talking here about the RBA cash rate moving, but mortgage rates have been increasing for about 6 months now. If you look at your fixed term loans in particular, which still a large number of people are taking out, 6 months ago, you could do 3, 4, 5 years around 2%, which is incredibly cheap. If you try and do that today, you're going to be at least 3%, maybe even 4% for the 5-year term. So it has actually been a real market shift already, with more to come, obviously, when the Reserve Bank do start to move.
That's interesting. We, again, in our blog, I think 3 times last year, from April through the end of the year, we're saying, things are moving. I think the RBA was saying it was 3 or 4 year timeline. Although 2024 is what they were saying, interest rates were going to move. And yet there's an article on the Fin today, Daniel, in relation to, they say that the budget they released on Tuesday night is probably going to fuel interest rate rises potentially a little faster. I mean, I don't know if you have an opinion around that at all.
I don't think they'll change the timing of the rate hikes too materially, but just because they're not too far off anyway. It's pretty hard to say, maybe they were going to go in September to start with, and they might go in August now. But definitely, there's a lot of money in the budget, a lot of spending that for many households is going to be some valuable relief, given the cost of living and petrol prices and all of that. But fundamentally, absolutely, it is sort of more money into the system on top of a hot economy and a low unemployment rate as well. So absolutely, things are going to remain, I guess, strong, but also increasingly expensive, and that will eventually support the eventual rate hikes as well.
Understand. Matt, we have Adam back. I think, Adam, can you hear us?
Yeah, Zoom froze on me at this end. And then locked out. IT, hey?
So we'll go back to.
Well, I guess let's
yeah.
jump back into it, Adam. I think we're all waiting with anticipation to your response to the tough questions. So just circling back, we were keen to, I guess, for you to comment on the reversion theme that Daniel touched on around commercial office trends, obviously, but also just some of these other surprising, I guess, winners in the market and whether that's here to stay and what you see as being the things that have sort of are pasted on now from the COVID disruption versus what's going to fall away.
Yeah, sure. Well, let what just happened be a great example of it. It's not ideal. It's far from ideal. And when we were doing these things in person, the interaction and the engagement that you got from everyone there is way better than anything. So we sort of have tolerated video conference and decentralisation to a point. I think there's two speeds to this. There's from an employee's point of view, this is nirvana. I mean, when else in history have you been able to get paid 100 cents in the dollar that your wage comprises, but never have to go to the office? So of course, employers are going to push back on this for as long as they possibly can. Interesting feedback. So I've been spending heaps of time talking to recruiters because when you read about things, they've already happened. So we spend a lot of time speaking to sources of truth that aren't necessarily directly property related. So you speak to architects, that will tell you what's coming down the development pipeline and where supply and demand is. If you want to understand where office occupancy comes from, go and speak to recruiters. So we've spent a lot of time speaking to recruiters, and they will tell you that labour's hard to find at the moment. No one's going to force anyone to come back to the office anytime soon for fear of losing staff because they can't replace them. But they're very obviously and somewhat covertly at the moment going to start to price signal the behaviours that they want to reward. So what does that mean? That the people in the offices will start getting pay rises and promotions. Now, there's a great article in the Fin Review last weekend from someone saying, well, that's great, I'm never going back to the office and I'm happy to take a pay cut or a demotion. Well, I'm calling BS on that because the reality is you could have done that pre-COVID. You didn't want to work in town and earn the big bucks. You could have taken a job locally at a lower wage with a lesser role. So there was no impediment to doing it then. So I think there's this there's a behavioural aspect now that's going to take a little bit to unwind. Fear of missing out tends to overtake all other forms of behaviour that we see in financial markets at the moment. So I'm not suggesting for 1 minute that office snaps back exactly to what it was, but the reality was office pre-COVID was already going through a fundamental change, as was retail. So, true retail, i.e., the goods was really unravelling as it was. There was already vacancy climbing in the strip shopping, and COVID absolutely supercharged it. And what we're seeing now is the reinventing of retail. So services now comprise a massive percentage of traditional neighbourhood retail and strip shopping retail. And now what you're seeing is the next iteration of that. So we're seeing now we're seeing car sales and servicing going into traditional supermarket locations. Kids' gyms, Bounce have just opened their first ever neighbourhood retail outlet. You're going to start to see a lot of that sort of traditional, which would have been almost industrial use, go into more traditional retail use. Don't underestimate the dynamic of EVs. You can't charge an EV at a traditional petrol station. So the question becomes, if you need to charge your car somewhere for an hour and go and do something else while that's happening, where do you go? So I think you're going to start to see the EV charging become very much a value proposition being offered by retail owners and by shopping centre owners, and in some cases by tenants. So you're going to start to see these really interesting things happen where what was once retail becomes a shandy of all these things. It becomes almost convenience retail, it becomes part industrial, and it becomes more traditional retail. And so the lines get blurred across all manner of types of property. And our office is the same. It's not just an office anymore. It becomes almost a park cafe, and it becomes part of conference facility. And that's within an organisation. They're literally breaking up the organisation into these disparate parts that fit each of those roles that might have been done external to the business. So, and if you look at the data behind office, it's really interesting, right? Because the nature of the way the workspace was changing, you probably needed a third of your workforce to work remotely to not have to increase your office footprint. What was happening was we got down to as low as about 8 square metres per employee. Just before COVID hit, that was starting to revert for about the first time in 2 decades. And it was going out to 1 to 10, and now it's going out towards 1 to 12. So on that basis alone, if you go from 8 square metres to 12 square metres, your footprint per employee is going up by 50%. So the question becomes, how much of your workforce do you actually need to work on a decentralised basis to keep your footprint as it is? So this idea of mass handback of space, I can tell you, it ain't happening. The leasing market, there's vacancy at the moment, but a lot of that's been driven by supply that was, delivered or started. The delivery was started pre-COVID, and it was finished and delivered to the market during or post-COVID. So that'll take a little while to work its way through, but on the ground, leasing is not too bad. I can only talk on our behalf, but all of our assets in Queensland, the finished assets are fully leased. One that we're going through at the moment, on a releasing basis, we've leased over 1,000 square metres of space that we hadn't actually modelled up to have leased by now. So there's already quite strong demand. And Matt, you asked about Melbourne. We're finding Melbourne reasonably robust. So we had a retail tenant in that Lonsdale Street asset hand the keys back. It was a pizza store. They were getting pummeled across multiple fronts. We had their rent paid up to March. We had a bank guarantee that saw their rent covered out to the end of the year. And we took a tenant from the other side of Lonsdale Street that wanted to be on Hardware Lane, and we signed a heads of agreement with them already to occupy the space at basically the same rent we were getting. So there's lots of statistics, if you like, in terms of what's actually happening out there. And it's competitive, but I don't think it's as bad as what they're saying. I caught the training this morning, as I've done most days since we were able to come back to the office. It's my threshold for what's happening. The train this morning was heaving, as was the train home last night. So I'm interested to see the next round of occupancy data. But on office, an interesting one, Hobart and Darwin, which were markets that practically had no lockdown, their office occupancy today is almost what it was pre-COVID, 92% of pre-COVID levels. Most of those businesses are businesses that are in Melbourne and Sydney and other markets that were in lockdown, and there's probably a corporate policy of working from home, yet in those markets, they're almost back to pre-COVID occupancy, and ask the question why. I think that the why answer to that is it's hard to develop your business in a decentralised method or manner, and it's hard to develop your staff in a decentralised manner. Some businesses can, where you're in either a very mature business or a very mature industry, and you can quite comfortably go sideways or maintain the status quo. But if you're trying to grow, very difficult. So what we're seeing in those markets that didn't have the same lockdown imposters we faced here, very, very divergent outcomes. And then you get other distortions. So I'll give you a couple of examples. I'm just referring to my notes at the moment. But has anyone ever heard of a term essential retail before COVID? It was once called a supermarket and or a convenience, a corner or a retail store or a service station. All of a sudden, it's been recoined essential retail because they say the income flows are bulletproof. Well, I don't know how many times we're planning on having COVID happen again, but I think it'll go back to supermarket retailing and traditional convenience retailing or petrol station type opportunities. But they're interesting, right? That off the back of that recoining of a phrase and those cash flows being seen to be COVID bulletproof, the pricing of those assets has gone through the roof. Now, look at if you look at service stations in particular, I think they're facing a really interesting dynamic. If you look at energy markets across the globe at the moment, they're really in the crossfire. And what does a petrol station become if it's not a petrol station? I don't think petrol stations can be reverse engineered to become EV charging stations, because you're not there for 5 minutes filling up your car. The car's there for 30 minutes to an hour. So what happens next? Where does that happen?
we think that actual office buildings and retail supermarkets are going to be the net winners out of an EV style charging dynamic. Childcare, it's another one that's gone consistently through the roof. To give you some context, yields on childcare now are tighter than yields on CBD commercial office assets in Melbourne. To me, that makes absolutely no sense, in particular where a lot of those assets are underpinned by a two-bit operator, that if they do a Houdini and disappear into a puff of smoke, you've paid about 2 to 3 times what the underlying property asset is worth. So on a risk-adjusted basis, there's been all these real distortions. And then healthcare, that's the other one. Healthcare and its latest derivative called life sciences, it's done phenomenal stuff. And any asset that's been deemed healthcare trades at a massive premium. Case in point, we owned an office building in Russell Street, South Brisbane. It was an office building tenanted by the state government of Queensland, and one of the 3 agencies that tenanted it was Queensland Health. It sold to a healthcare property business because we had a health-based tenant in an office building. Now, at the end of the day, it was an office building, but it sold on a healthcare dynamic to a healthcare operator at a premium. So there's all these funny little things that have happened off the back of COVID on the basis of the absolute, the strength or how bulletproof the cash flows are, and it's sort of lost a little bit of touch with reality, if I'm honest. And this is where, for us, things start to look a little bit interesting in terms of construct. So, general observations. We've got a lot of misinformation, and there's a lot of bubbles forming in different little parts. You've really got to pick through the weeds at the moment. Get into the market and speak to people. You'd be amazed at the little pearls of wisdom that get dropped in front of you on occasion, whether it's be speaking to accountants on what their clients are doing or recruiters or others. There's some really interesting human behaviour elements at play here. And I think we've got to follow the threads. The data that Daniel presented was quite fascinating, right? I'm really, really keen to see how some of these things shift over the next 6 to 12 months. I think there are going to be some serious net winners and losers. An interesting point, it was bounced at me and I hadn't thought about it until someone suggested it, and the more I think about it, the more I think they're right. It started in, not in property, in venture capital, where the context or the construct was that a lot of the big VC funds keep reinvesting in future rounds to underpin the valuation of the previous round they went in at. So it's a way of sort of underwriting your own investment position. I'd say that there's a bit of that happening in the commercial property sector at the moment. The big players keep buying at ever tighter prices to underwrite the rest of their valuation book. That's great until it's not. So I don't really know what that means or how it plays out, but I think as a behavioural observation, that's at play. Anyone in our space that's a value buyer, I'm not seeing a great deal of market activity from.
So Adam, just on that one, we've got a question through from the webinar Q&A. It was just about short and mid-term commercial prices, just about that. So you said there's some bigger, where do you see the short and mid-term commercial property prices in Melbourne and Sydney? Some value buyers, you were saying, that aren't really doing much, but others that are buying that are potentially bigger purchases. So where do you see that heading?
I'll be honest with you, I don't know. And I don't know, and I'll share with you why I don't know. And it's not just me either. I had just happened to get lucky enough a few weeks ago to sit in on a session. There was 4 of us, one of whom was Mark Burgess, the former chair of the Future Fund. And I happened to sort of see Mark in a few of these things and got to know him okay enough to ask him the direct question, go, Mark, I don't understand what the hell's going on out there. Can you please tell me that you know? And he said, I'm scratching my head too. So neither of us can sort of understand where things are at the moment. And in a true property sense, where I'm going with this is you've got this insane amount of money that got pumped into the market from COVID. And cash still feels expensive and people feel compelled to get that invested and generate a return. So what it's doing is it's pushing yields down or pushing prices up. But on the inverse side of that equation, or the other side of that equation, interest rates, so 3-year money's gone from 65 basis points 6 months ago to 270 yesterday. So you've got nearly 210 bips of cost that's been stuffed into the structure somewhere, and yet pricing's still tightening. And then you overlay to that the cost of rent, or what you can derive from rent, has decreased because net effective rents have fallen as incentives have gone up to try and attract tenants to a building. And then you've got to do fit out works, and you've got materials costs and the unavailability of trades or certain materials to do these works. So all your input costs are going up at the same time pricing is continuing to tighten. Where does this end up? I'm not entirely sure. But at the moment, we have got one hell of a margin squeeze happening.
Well, that's somewhat sobering, but
it is, Matt. But things will come out of this where there will be opportunity. But broadly at the moment, we're sitting there just scratching the head a little, saying, "How does this play out?" And the art forms, as much as avoiding the hit as it is actually investing or participating in the opportunity. So at the moment, we're trying to look for where the bus is coming from behind us that we haven't seen yet, because that sort of goes to the risk avoidance part of it. And dare I say, there are a few buses cruising around in the background at the moment, whether it's inflation, whether it's interest rates. And inflation long term is good for property because it pushes up rents and gives you a greater economic return from the real estate. But short term, it creates a valuation squeeze as cap rates soften, and you sort of need to navigate those pinch points.
Yeah, great summary. Well, I think we're done for time now. Thanks everyone for joining today, and especially thank you to Daniel and Adam. Really great insights. Saw some excellent data there, Daniel, to get a real sense of where things are at the moment, and nice to hear some of those grassroots interactions that you're having, Adam, and the little chestnuts of information that are coming from those as well. So
when we got him back.
When we got you back.
I felt like a news presenter that lost the live stream there, Adam, when you left us.
Yeah, so thanks for joining, and we'll be in touch soon. Have a great day.
Thanks everyone.
Thank you.
Thanks all. Bye.